Welcome back to another very exciting episode of Perpetual Cash Flow. I'm your host, Brad Bennett, and today we are going to talk about the next steps in your cash flow structure. The first ones, we're putting the structure in place and redirecting the flow of money so that your financial freedom has been moved to the top of the food chain. Now, we have this cash flow structure in place. The paycheck is now going into the reservoir. You decide how much is going to move from the reservoir into the checking to maintain your lifestyle. And as a result, you are now capturing the excess in the reservoir. Now, this reservoir is just like a man-made lake, man-made reservoir. The entire purpose is to capture all of the water that is coming into the reservoir. And then we decide how it is going to be sent downstream so that we're able to use it at its highest and best function. And that is as we look at summertime with the reservoir, we're holding back the spring runoff so that we're able to water the fields and produce much more food than we would have been able to otherwise. In this case, where we're creating the cash flow reservoir, the purpose of capturing the excess is so that we can now deploy it in acquiring what we call tax advantaged cash flow engines. And these begin to take pressure off of the paycheck. So there's a couple of steps that we want to take, some order of importance, and we want to be very intentional as we move through this process so that you're getting the highest and best use out of every dollar to reach your maximum wealth potential. So the first thing that we want to do as we have excess in the reservoir is one, we got to get rid of credit card debt. Now, I know a lot of you out there, you use your credit cards to finance your monthly expenditures because they have rewards. It's a points card. So that's how you pay for airfare. It's how you get rewards points at hotels, whatever it may be. If that's how it's being used and you're really paying it off at the end of every single month, great. Keep doing that. Keep getting your rewards. The problem is there are far too many people that I see carrying $20,000, $30,000 in credit card debt. The corrosiveness of these credit card payments is far greater than anything you've ever imagined. When you're carrying 20, 30,000 or so in credit card debt, it's not uncommon for you to be spending $1,000 per month on credit card statements. Now, yes, you're feeling the squeeze, you're feeling the burden of that, but you may not entirely realize the true corrosive nature of those credit card payments. When we take those over a 30-year period of time, that $12,000 a year in credit card payments, it adds up to a huge number. It's $360,000 that's leaving your world never to return. Most people that they're starting a job, they're making 100,000 a year and they're maxing out the 401k, they're getting the match. The likelihood of the ending balance of that 401k is really somewhere around $500,000 or $600,000, just with the nature of those accounts and how they function. You're more than halfway there by what you've given up through credit card payments. Now, here's where it is mind blowing. If we're able to recapture that same $1,000 a month, and you're now able to get it into a cash flow engine or an asset where you're receiving, let's say, 5% annual rate of return um, over the same 30-year period of time, it's nearly $800,000 more than what the average 401k balance is when people retire, almost double what the average is. This is a huge, huge problem. We've got to get rid of those credit cards so that you have more money staying inside of your world that you're able to put to work for you in accomplishing your financial freedom. Now, the second thing that we need to look at is the emergency fund. We'll have to abbreviate that because of my other notes, they got too big. But we all know that we need a 3 month or so emergency fund. The problem is we just don't end up getting there because of the financial gravity and all of that gravitational pull coming against every single dollar that comes into our world. As a result, when an emergency happens, it throws us back to the credit cards. It just compounds the cycle that keeps us trapped and keeps us from getting to where we want to be. Then, once we have excess, this is where we start to acquire what are called tax advantaged cash flow engines. There's a difference between the traditional type of investment that we've been taught in a retirement account where we're hoping the value goes up. A tax advantaged cash flow engine lets us be taxed at a lower tax rate on the cash flow that comes from the asset. In addition to that, it's going to throw off income in one way or another, either on a monthly or an annual basis. This now takes pressure off of the paycheck. As the pressure is relieved from the paycheck, now we're able to increase the rate of savings. It creates that velocity of money that's now working in your favor instead of another institution. A lot of times people will ask me um, why these I focus so heavily on a cash flow engine instead of the equity type investment. I don't have a problem with an equity type investment where you're wanting it to go up in value. If that's what you love doing, great. Let's keep doing that. But a lot of times, as people begin to realize and understand the power of cash flow, they begin to make a little bit of a shift. Some of them, they make a 100% shift. Some of it is 50-50. It really just depends on you and what fits best for what you want to accomplish. So, with an equity based investment, like mutual funds, in order to live off of them, you have to sell it in order to spend it. So, it's a depletion resource. Every time you sell them, you're not going to see any additional income off of the asset. In addition to that, they are subject to market value. So, let's say that we're in retirement and all of a sudden the market takes a dive by 40% you now have to sell off a greater number of mutual funds in order to maintain the same standard of living, which puts you in greater jeopardy of that asset collapsing. There's some things that we can do to protect against it that we don't see happen often enough, but we can address those things to make it a bit more friendly for you during that period of time. And depending upon how it's invested will be depend upon what the taxes are going to be on that asset when you spend it. Whereas a cash flow engine, this is throwing off money every year, regardless of what's going on in the economy. In the market, see, going into 2008, I wasn't concerned about the value of my assets because they were cash flow assets. I had a lot of neighbors that were freaked out as their property values were cut in half, and I was okay with that. The reason I was okay with that is the value didn't dictate the cash flow. This is why Warren Buffett, when he was talking about Coca-Cola, he was in a conference and he mentioned, I love seeing everybody out here drinking Coke because I own preferred stock in Coke. So I don't remember the exact numbers, fourth or fifth Coke that you drink, that's a dividend that goes to me. See, the Coke stock could go to zero, but if people are still drinking Coca-Cola, Buffett still gets his dividend. It's the same thing in structuring a cash flow portfolio. It doesn't matter so much if the asset value drops because the cash flow continues. It continues to feed you through the ups and downs of life and retirement, whatever it may be. So that is why we prefer to focus on creating cash flow engines. And in another video, I'll go through some examples of cash flow engines, what they are, what they look like, and how they begin to take pressure off of your paycheck to lead you further and further down the road to creating your financial freedom, in addition to building an asset base that will feed you through retirement that you don't have to worry about as much going to zero as if you had an equity based portfolio. And in addition to that, you now begin to create an asset base that creates a legacy family, something that you're able to pass on from generation to generation, helping your kids, your grandkids, your great grandkids begin to get a leg up and being able to take advantage to some of the greater things in life without always having to start at zero because of what we've been taught and how we're taught to do things in building our nest egg and following their cash flow structure.